In this week's video, we'll review the latest charts and data to help us answer the question, will a 2026 recession derail the bull market? As a risk manager, when things are going well, you should always be asking yourself, what am I missing or what potentially could go wrong? And we want to be making decisions in the context of understanding and respecting the strengths and potential weaknesses of our approach or any model or system. And we'll be examining these concepts in the context of the economy, but we could do the same thing with numerous questions. The story on December 3rd was that private companies had cut an unexpected 32,000 jobs in November, potentially concerning. And if you search for Recession 2026, you will find no shortage of articles to review. Now fast forward one day to December 4th, and the news was better. So as we head into 2026 in the context of our approach and our models, we'll discuss some of the common errors that human beings make when leveraging data to try to make better decisions. The chart on your screen is the ratio of the S&P 500 index relative to the price of a 30-year U.S. Treasury bond, or more simply, stocks versus bonds. And we're going to walk forward from 1997 all the way to 2010 and see what we can learn about the present day, using the exact same moving averages which span between the 20-week moving average in blue all the way out to the 250-week moving average in black. The observable evidence that we had in hand in Q1 of 1999 still look good. This is clearly a long-term uptrend. And if we walk forward to the peaking process in the year 2000, the S&P 500, shown in the lower panel on the chart, the S&P 500 peaks in March of the year 2000. Keep in mind, this is a weekly chart. The daily closing high came in March. And we know that technical analysis is about subtle shifts. Nothing particularly alarming here, but this looks worse relative to anything that we've seen back here. For several months now, this ratio has failed to print a higher high as the S&P 500, especially on the daily chart, is printing higher highs. In real time, we would classify this as a yellow flag. So in September of the year 2000, we're really just paying closer attention at this point. But if we walk forward to July 20th of 2001, now we have something that's more than a subtle shift. We don't have anything like this in the rearview mirror dating back to 1997. So this is a long-term ratio trend that's on the ropes. So at this point, our incremental shifts in our allocation from point A to point B allow us to see how this plays out. We don't want to extrapolate here. We want to understand that this trend is highly vulnerable, but it's also at a point where it could make a stand. So our allocations at this point should be in line with the evidence that we have in hand. And it's noteworthy, with this highly vulnerable look in July of 2001, we have something on our screen and in our models that looks significantly different relative to what we have back here. Was it too late to take additional incremental action at this point? The answer is absolutely, positively no. From this look here that we could see, measure, and put in a model, the S&P 500 lost an additional 35.85%. And in terms of the S&P 500 index, the loss from point A here to point B in October of 2002 was almost 50%. If we're allocated properly at this point, it's much, much easier to take it day by day, knowing that you've already taken some defensive action before what morphs into an extremely painful drawdown. And just as we didn't want to extrapolate from this position here, we don't want to assume that this trend is going to continue indefinitely in a negative manner. That's where the flexible, unbiased, and open mind comes into play. None of this is particularly helpful if you continually extrapolate and feel like you know what is going to happen next. And in this case, the market eventually did find a bottom in October of 2002, and it retested that low in the spring of 2003. Chart on your screen now, same ratios, same moving averages, and we're in 2006, and things are starting to look a lot more constructive in here. But as the S&P 500 starts to peak in this window here in October of 2007, once again, we have a discernible lower high in this ratio when the S&P 500 on a daily chart prints a higher high, just like this period up here. This is not a red flag, it's a yellow flag. It's a subtle shift, and you can see the trend line on the ratio here has been broken. Another subtle shift telling us to just pay closer attention. And having an open mind in October of 2007, that was a good thing, because walking forward, the S&P 500 down here and the ratio continued to deteriorate. So at this point, once again, the long-term trend is on the ropes. So this point here, similar to this window in here in 2001, and we know what happened next there. It was ugly. But we don't want to make that assumption in the present day. We just want to make sure that we're allocated properly at this point. We want to be able to deal with a wide range of outcomes from here, from wildly bullish in early 2008 to wildly bearish. And the look of the chart on July 27th, 2008, we put this into the very concerning category. This point right here looks similar to this point here from a price perspective. Also noteworthy, this looks significantly different relative to anything that we've seen in this window here. We've broken this trend line, and now we've made a lower low, and we're on the verge potentially of making an additional lower low. But as long as we've taken incremental action defensively in our portfolios, that's going to allow us to observe this with an open mind. If you know your stock market history, walking forward from June of 2008, there was a lot of pain ahead. Once again, when we could see this, measure it, and put it in a model, the additional drawdown from June 27, 2008 was a whopping 48.08%. So from this point here, we really don't have to predict anything. We have evidence in hand here that tells us this market is highly vulnerable. And as long as we have an open mind about what happens next, and we've taken incremental defensive action, we can go either way here. And in this case, the loss in the S&P 500 on a daily chart from the highest closing high in October of 2007 to the lowest closing low in March of 2009 resulted in a drawdown in the S&P 500 of a staggering 56.78%. Buy and hold works until it doesn't. It's also noteworthy here. We know markets operate in fractals. We're making a discernible lower high in the ratio here relative to this high here. Also concerning. And as it turns out, the pain from this point here was actually worse from this point here. Things happened much faster and the magnitude was greater. So since human beings like stories, what is the story here? The story is in this window here, some market participants begin to respect the increasing probability that the economy is going to go into a recession. And if that's the case, eventually that's going to hit corporate earnings. And eventually the Fed is going to lower interest rates, which is good for bonds. Hence the shift in this ratio. This is what we would expect during a deflationary bear market, that stocks would significantly underperform bonds. Same thing happens over here. In a deflationary bear market, a traditional bear market, also marked by a recession and the financial crisis, everything on your screen here passes the common economic sense test. And that's why we always want to have a base case story that aligns with the data in front of us. Why do we want to have a story? because the story helps us execute, and it's also something else to measure against. If our story is bearish here, and the market ends up moving out here, then that's starting to contradict that story. And we're going to have to shift our base case. And just as we didn't want to make any assumptions about what's going to happen next in this window here, when things are really, really bad and all the charts look bearish, we should keep an open mind about a rapid reversal. And that open mind hopefully can help us mitigate this massive drawdown in the S&P 500 and mitigate this massive drawdown in the S&P 500. Notice we're using the word mitigate, not avoid. So in the present day, this is the type of look that we would want to avoid. This is the type of look that we want to avoid. So does the present day have any of these characteristics, these topping characteristics? To answer that, let's look at the exact same ratio, stocks relative to bonds, using the exact same moving averages from the 20-week in blue all the way out to the 250-week in black. Does the present day look anything like this or this? The answer is no. Chart on your screen dated December 4th, 2025. And what's the base case story in the present day? That we're on the brink of a transformational productivity boom, driven by innovations like AI, robotics, and life sciences. And in our case, we're in a secular bull market primarily driven by demographics. Improvements in productivity fits right into that type of story. So this aligns nicely with the logical approach, which is the data-based approach, the chart in front of us. Let's compare the look of the ratio or price relative to the moving averages to the look that we want to avoid. Compare the look of the ratio relative to the moving averages up here and here relative to what we have on December 4th, 2025. Video being recorded during the trading session on Friday, December 5th, 2025. If this, in 2026, starts to morph into something more like this, concerns would increase. But in early December 2025, the look of this chart, upper right-hand corner of your screen, aligns with, rather than contradicts, our base case. And if the data starts to drift from our story, then we have to be willing to make adjustments to our allocations. Because nobody wants to be a buy and hold investor during a period like this, a period of secular stagnation, where we have one 50% drawdown and then another 50% drawdown back to back. It's real easy to be a buy and hold investor up here. It's a lot harder to be a buy and hold investor down here. Because during this 10-year period, roughly, what's happening on your screen and what's showing up on your monthly statements does not align with the concept of buy and hold. It'll get harder and harder every single day. Another fair question: how are our models helpful in this environment? So let's go back to the peaking process when the dot-com bubble is bursting. You can simplify things here. If you draw a trend line in the S&P 500, we've clearly broken the trend line here in Q4 of the year 2000. And this ratio chart clearly looks more vulnerable and significantly different relative to this period in here dating back to 1997. And the same is true. We can take this chart all the way back to 1994 or 1995, and we don't have anything that looks like this. Thus, it's fair to ask and answer: what were the CCM's secular volatility model scores? And in this case, we're going to be focusing on the scores related to mitigation 1 on July 20th of the year 2001. And that's the chart, lower left-hand corner of your screen. This is the S&P 500 on July 20th of 2001. And that will allow us to compare the scores here to the scores on December 5th, 2025. Since we created this model, the answer is these are highly vulnerable. A low score here is concerning, and this high score here tells you that you're checking a lot of correction type boxes. And the same can be said, we're checking a lot of boxes that you see during a 30 to 50% drawdown, telling us that we should be open to things getting worse from this point here. And they got a lot worse. Thus, in the present day, if we see low numbers up here and high numbers down here, concerns would increase. And on December 5th, we just don't have that. In fact, we really have the polar opposite. We don't have low numbers up here. We have high numbers up here. This tells us we're not particularly vulnerable to something like this. All of this speaks to probabilities, not certainties. And we said we didn't want to have high numbers down here, and we don't. This, and this are significantly different relative to this, and this. So we want to blend our hard data approach with economic common sense and human psychology. And ultimately, we're trying to discern between volatility to ignore within the context of an existing uptrend and volatility to respect that requires defensive action. So we just reviewed the dot-com bubble case and compared the scores from this look here to the present day. How about if we perform the exact same exercise on June 27th of 2008, right before things got really, really ugly in the S&P 500. And notice here how much visible deterioration that you can see. You don't have to pick the top. You didn't have to know that we were peaking in October of 2007, especially if you made some incremental adjustments between point A and point B. So how about the scores? In this case, we'll put them side by side, making them easy to compare. We don't want low numbers up here. We do not have low numbers in December of 2025. And we don't want high numbers down here. And you can see the present day over here really doesn't look anything like the numbers that we could see and that were based on the data that we had in hand on June 27th of 2008 before the S&P 500 lost an additional 47%. Much like the ratio chart that we just covered, something that just happened, source of the information on your screen here, aligns with rather than contradicts our base case. XLK, the tech sector ETF for the S&P 500, was up 9 trading days in a row. Study period also fits in nicely with the charts we just covered. Our charts went back to 1997, study back to 1998. It's only happened a handful of times. In the historical cases, what happened to XLK in the subsequent year? The answer is typically good things happened. Average gain 16.99%. That's the average additional gain. In 93% of the historical cases, XLK was higher a year later, and even in the down scenario, down less than 5% a year later. Another positive data set telling us to keep an open mind about much better than expected outcomes over the next calendar year. These are historical cases when the S&P 500 drops 10% or more intra-year and then eventually finishes the year with positive returns. Looking at data going all the way back to the early 1970s here, only happened a handful of times. Source of the data on your screen, down here. You can find them on X. What happened over the next year? The average additional gain in the S&P 500, almost 19%. The median gain, 18.35%, with relatively muted volatility between point A and point B. And we all know The only way that we can use all of this, especially the concepts, effectively, is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.